An interview with an accountant.
You're an accountant. My first question is this. How is an accountant different to a bookkeeper?
A bookkeeper records all the financial transactions in the company. It's a job that is done internally. You take the paperwork from sales and purchases. That means invoices, receipts, bills and payments, and enter the information in the correct place in a spreadsheet. In the old days, it was a book.
And what does an accountant do?
The accountant is an external person who takes this information, checks it, and then uses it to create the financial reports.
The income statement, the balance sheet, and the cash flow statement.
Yes. Those reports are filed with government agencies every year, and the accountant has to sign them off. That means sign that they are correct.
OK, perhaps you could talk us through one of the reports.
Yes, I'll give you the example of the income statement, which many people call the profit and loss, by the way. We start with revenue. This is the money that the company receives from its sales. Then, from this revenue, we take away the cost of making the goods, and that gives us the gross profit.
Those costs of making the goods are called direct costs.
Yes, things like raw materials, the wages of the factory workers, everything directly involved in making the product.
OK.
From the gross profit, we subtract the other costs, the indirect costs. These are things like marketing, administration, and so on. The figure we get at the end of that is the operating profit.
OK.
Now we have to take away things like amortization, depreciation, and tax.
OK, tax I understand. You make a profit, so you pay tax. But what about amortization and depreciation?
They are very similar. In everyday language, you can use either word. Only accountants need to know the difference. The basic idea is that you spread the cost of an asset, like a computer or a vehicle, over several years. Imagine that you buy a computer system for €5,000. You don't enter all 5,000 in the accounts in 1 year. If you choose a 5-year period, then you enter €1,000 each year.
Right. So when you've subtracted tax and amortization, what's left?
The amount that is left is the net profit. It's like the final profit.
Of course, it could be a loss instead of a profit.
It certainly could.
So this net profit, is that what people refer to when they use the phrase the bottom line?
Yes, it is. The top line is revenue, and the bottom line is net profit. You might hear someone say, top line growth last year was 4%, but we improved the bottom line by 10%.
That means that income from sales grew by 4%, but they managed their costs very well, and so they got a final profit of more than that, 10%.
Yes. The opposite situation is also very common. High top-line growth, but only a small net profit.
In this case, a lot of goods were sold, but they were sold cheaply.
Exactly.
So is net profit the final line on the income statement?
No, because we still have to show any dividends paid to shareholders. The shareholders took a risk when they invested their money in the company, and so they expect to see a part of the profits returned to them.
But they don't take all the profit?
No, the rest is reinvested in the company for future growth. That part is called the retained profit.